Hi, and welcome to the third topic in accounting for managerial decisions. In it, we'll be looking at the statement of financial position. There are a number of things that we're going to cover in this particular topic, obviously all pertaining to the statement of financial position or balance sheet is often heard. So within it, we're just going to look at what it's all about, also the effects of accounting policy choices and estimates, because accounting is not black and white. There are shades of grey and shades of subjectivity and professional judgment. And so we're going to look at how some of these impact on the statement of financial position and just statements more generally. We're then going to look again at asset, liability, and equity definitions. And we're going to take that a step further, not just looking at the definitions, but also the recognition criteria. So not only is something an asset, but how do we get that asset, for example, onto the financial statements? We'll then actually turn and look at an example of a statement of financial position. I would urge you all to do much the same, either with the same example that we're using or any that you would like to find. So just how they're formatted, how they're presented, what's in them, where to find it. We'll talk about some of the disclosure requirements and presentation requirements as part of that. Then we'll look at the measurement of various assets and liabilities on the statement of financial position. So we'll look at three in particular here. So we're going to look at inventory, receivables, and non-current assets, which make up a fair portion of the asset side of the statement of financial position. We're not really going to look at the measurement in relation to liabilities. Certainly, it's important to know that liabilities exist and what sort of things are commonly there, but we're not really going to delve into the measurement parts of liabilities in this particular topic. And to wrap up with a number of limitations around the statement of financial position, which also pertain to just accounting more generally. So the statement of financial position is a financial statement that details the entity's assets, liabilities, and equity as at a particular point in time, which is the end of the reporting period. So it's like a snapshot. It's if you were to take a photo, for example, at a particular point in time, we would then be able to say at that point, what is the entity? So the assets are what the entity controls. We've already talked about that it's not ownership necessarily, although ownership and control heavily overlap. So what the entity is, and then who has claims on that. So is it an external claim holder? So the liabilities. So these are what the entity owe to third parties. And then we're looking at the owner's claim on the entity's assets, the equity component. So this is the 2017 statement of financial position for Woolworths. So feel free to go and have a look at it in more detail. Obviously, in as of itself, right at the moment, it's probably a little bit hard to see on your screen. So we will be zooming in a little bit as we go through. But feel free to have a look in more detail yourself. Accounting policies are those accounting choices applied to the recognition and measurement of elements in the financial statements. So there are a range of accounting rules. So we use International Financial Reporting Standards as they're codified as Australian accounting standards here in Australia. And that gives, not just a guide, that's the set of rules which companies have to follow. But within that, there is a fair amount of choice. And that choice makes sense because not every company is the same. With that, the policy that a company chooses, they can give rise to certain scope around whether or not to recognize something or what type of element to recognize it as, and in some cases also the amount that they recognize it at. So some of these examples could be along things like inventory costing methods, which we'll look at later. It could be around depreciation calculation, again, which we'll look at later. Or thirdly, the treatment of development expenditure, which, depending on how certain sort of criteria have been satisfied, may be allowed to be capitalized as an asset or may have to be expensed out. But what we're turning to is, if we think back to topic 2, when it comes to transaction analysis, the middle two sections of that, identifying the amount, so the cash effect, and identifying which accounts, which was the nature of the transaction. These are the two things that these accounting policies really turn on. Third time's a charm. I think we may not see this again next week, but you never know. Asset, liability, and equity definitions, and yes, we're showing it again. So an asset is a present economic resource controlled by the entity as a result of past events. A liability is a present obligation of the entity to transfer an economic resource as a result of past events, and equity is just whatever's left over. So turning to assets and liabilities, something has to have already happened. For an asset, you have control and you're going to get a benefit. For liability, you owe someone money and you have to give up something to make that happen. When we think about recognition, what recognition refers to in an accounting sense. So if you hear someone, an accountant, talking about recognition, or certainly a financial accountant, they're talking about putting it onto the financial statements. So this is when a dollar figure, if we're talking in Australia, but a monetary value has been assigned to that element and it is in the financial statements. Now, this isn't always a clear-cut decision. So there may be uncertainty about what the thing is. We can talk about certain tangible assets. We can talk about, we mentioned development costs, development expenditure before. There's uncertainty as to what it actually is. It could be a probability issue. And something that springs to mind quite often with these sort of things is in relation to lawsuits. Where is it at? What's a probability of a loss? Is it high probability, low probability, almost negligible probability? Does that affect or change what's going to happen in terms of your being able to recognize it? In terms of measurement uncertainty, in many cases, the numbers attached are going to be relatively certain. But for example, if in times of financial stress, sort of economic, global economic or sort of countrywide sort of economic stress, there may be very large changes in asset values. So you may see quite large shifts in financial securities, in share prices, in bond prices, and so on. The value that's attached to a particular item, it may be hard to actually come up with a number that's going to hold. It could be issues around losses or impairment losses around bank loan books that may be hard to understand, or for them to determine how many of those, or what value of loans are going to be impaired and may not get paid back. So there are things which feature in terms of how you recognize something, especially when we can only put on a dollar, like a single figure, not a range of figures. So again, coming back to how the statements of financial position look, this is fairly standard for sort of a corporate. Two things to note, actually there's going to be a third, but we'll come down to it, is the narrative format. So it goes down the page. So assets, non-current assets, current liabilities, non-current liabilities, equity. So it runs down the page. They also include comparative information. So it allows you to see how things have changed from the previous year to the current year. It's only 2 years, so you can't really get that much of a sense of trend, but it does allow you to at least see if there's been any major shifts in recent time. When we start to look at financial statement analysis in a few topics' time, you'd like to see larger trends. That would be beneficial. The other thing, and I haven't put a note to it here, but is if you look just to the left of 2017, there is a series of notes. And not every single item, for example, inventory doesn't seem to have a note, but every single item, for the most part, has a note reference. So you can go off and see what the details of those items were. Well, not in full, but at least a little bit more information than what is on what we call the face of the financial statements. Presentation and disclosure requirements. So, as we noted, accounting standards exist, and they exist to provide some level of detail of what you're meant to show and how you're meant to show it and how much. Again, there is some level of choice within them. One of the things from a presentational point of view, which is important, is this current non-current split. And what we mean by that is you actually separate these two things out. And if it's current, if it's an asset, you expect to get the benefit within the next 12 months. If it's a liability, you expect that outflow to happen within the next 12 months. And that's really important for a user to start to tell, do they have enough available resources to pay off their short-term debts? Because if they don't, if all their resources are tied up in non-liquid assets, in property, for example, it may be hard to realize, cash to be able to pay off these short-term liabilities if that is the case. So current is within the next 12 months. Non-current is everything else. Turning to assets, we define them, we classify them. We've already defined assets, but how we classify them is in accordance to their nature and to their function. And the classifications can reflect a whole range of different things. It could be liquidity, it could be actual physical characteristics, it could be purpose. If you look at enough financial reports, you'll see a lot of similar asset types, but this isn't to say that companies can't choose something which is outside the norm, if it reflects what's actually going on and what their business is. So this is Woolworths. It's a little bit clearer. You can see it, a little bit more closely. They have 4 current asset types and they've got 5 non-current assets. In terms of their current assets, usual sort of things, cash, receivables, inventories, and they've got a very small amount of other. In non-current, they've got receivables again. They've got other financial assets, whatever they happen to be. If you're interested, you can check note 3.2. They've got property, plant, and equipment, so buildings, machinery, checkout terminals, all that sort of stuff. Intangible assets, and not a small amount, but deferred tax assets. So most of those, cash and receivables should be relatively familiar by now. Inventory, the biggest current asset they've got. So about $4 billion worth of inventory on hand. It's a retailer. That makes sense. Assets held for sale is not something we talk about too much, so we'll skip over that here. If you are interested, please get in touch. Trade and other receivables, we've talked about. Other financial, we don't know what they happen to be, but you could look them up. Property, plant, and equipment, the big portion of them. So $8.5 billion of their assets, of the $22.9 billion is PPE, and a significant portion are intangible assets. Now, it is worth going and having a look at what their intangible assets are, because from memory, it is not brand name, which is most part. They're actually a number of other things. So again, it's where 3.4 is useful, and you can go and actually see what their intangible assets are. And if you've got questions about those things, if you've had a look and you're not too sure, please, by all means, put it on Canvas or ask here, and see what we think, see what other people think about what it could be. Turning now to liabilities, and liabilities are classified according to their nature. They can reflect a range of things, including liquidity, level of security or guarantee, or when they're expected to happen. And again, we see a lot of common, certainly for our purposes, a lot of common examples of liabilities, especially in Woolworths. So Woolworths have about $13 billion in liabilities. They've got 5 current, they've got 4 non-current, they've got payables, they've got borrowings, they've got tax payable, and they've got other financial liabilities. Trade payables, is their biggest one. They've got $6.5 billion in trade payables, so it's about half of their liabilities is to their suppliers. A large part of that would be where they get their inventory from. It could be other payables to employees, for example, if they haven't been paid wages for that little bit at the end of the year. That's the biggest chunk. They've got a little bit of short-term debt, so about $250 million. They've got $2.75 billion in long-term borrowings. So again, debt is about $3 billion of that. They have a small amount of tax payable. They've got a reasonable amount of other financial liabilities, whatever they happen to be. And they have about $1.5 billion of provisions. Again, I haven't got the details to hand, but I would hazard a lot of that would probably be in relation to employee benefit provisions, leave provisions, and things like that. Again, you can get some clarity on that if you go to note 3.9. They've also got $1 billion worth of provisions in non-current. I'm hazarding a lot of that would be, as I said, in relation to employee benefits. Equity terminology and presentation will vary with entity structure. We're focusing on companies here. If it's a partnership, if it's a sole trader, they will be slightly different. We're just focusing on companies. So you'll have three main types, and then I've added in this last bit just for reference. It's not really important for us, but you'll often see it in a lot of the statements that we could be looking at. So share capital is the money received from investors when they floated or when they looked for seasoned equity offerings and putting out more stock. So that's the money that's actually being provided, sort of the net amount of money that is being provided to the company. In Woolworth's case, they've got about $5.5 billion of that. That number is obviously very different to the market value of the shares now. Retained earnings is all the profits that they've earned over time from day zero to now that has not gone out in dividends. So in retained earnings, they've got about $3.8 billion. So it means all their profits added up. They've given away a fair amount of dividends, obviously, and what they've retained within the business is $3.8 billion. Reserves are a really small portion. As we look at it, only 113 billion. A really important thing to note about reserves. I was recently reading an article about university reserves and noted that noticed one of the universities had only a small amount of reserves, but reserves don't mean that you've got this cash reserve sitting there. That's not what they mean at all. Reserve is basically where if you've had potentially a movement in a hedging, so you've got a foreign currency hedge, for example, and it's a movement in that position. So you might have used some sort of financial instrument to hedge a foreign currency risk. That change in that instrument may end up in reserve because the regulators didn't think that should go into profit and loss. A reserve is just kind of this catch-all place where you put changes in asset and liability values in. It's not saying that they actually have $113 million sitting there in cash as a reserve for something. The final thing is, as a small point, is non-controlling interests. And these exist because if Woolworths has subsidiary companies, which it does have, and if it doesn't own them 100%, it means somebody else has an ownership share. And it's a little bit complicated, the accounting for subsidiaries, and certainly the accounting for joint ventures is then a whole different kettle of fish. But the accounting for subsidiaries, we assume when we are supposed to create the accounts and we do the consolidated accounts, which is what we've got here, is that we take it as they control everything and that they kind of have the whole bit. But that's not entirely true. So the 9.8 is the total equity, but of that, only 9.5 is actually kind of the equity to the holders of the parent entity. So if I have all shares, my interest is in the 9.5, not that additional 350 million. Again, it's not an important element of what we're doing in this subject, but it's something just to be aware of. The measurement of various assets and liabilities. Now, this is where people start to go, accounting, you can pretty much make it whatever you want to be. And, there is some truth to that. The dollar value assigned to assets and liabilities is called their carrying amount or their book value. And this is where the problems lie. And this has actually been a bone of contention amongst accountants, amongst accounting academics, regulators around what numbers should we use, because we don't just use historical cost. If we just use historical cost and what we paid for something, then those figures would be really out of date. But using more up-to-date figures also causes problems, and they're difficult to come by, and they may not be objective. Value in use, which we'll see, is a really complicated number as well to actually work out in practice. So there's a whole range of different systems in play. And so the number that we end up with as a total asset figure or a total liability figure is arguably, a bit of a mishmash. So there are four that we'll focus on here. And this is just to be aware that there are different measurement systems. So historical cost just reflects the value in the market at the time that you acquired the asset or you incurred the liability. So if I bought a piece of land 50 years ago for $10,000, and the historical cost of that land would still be $10,000 on my books today. Now that doesn't seem that useful for decision making because that land would not be worth $10,000 now. A current cost and fair value is starting to get more to kind of the value sort of now. So the current cost is the cash or cash equivalent value that would have been paid to replace the asset at the measurement date or to settle the obligation at measurement date. So if you're looking to replace something at that time, that is the amount that it should be. And there's problems with current costs as a system. It's somewhat difficult to use. Fair value is used in quite a number of different assets, certainly things like certainly assets which are observable in a market. So shares, for example, if you hold shares in an entity, you have observable asset prices for them. So you can work with that. There may be other assets where you're able to actually ascertain what they are. House prices, apartment prices, you may not have an exact match, but you could probably find something which is equivalent and make a small adjustment to the value of yours. It's still going to be closer than whatever you paid for it 50 years ago. So the fair value is the price received to sell an asset or to transfer a liability in an orderly transaction between market participants at the measurement date. This has from time to time some super interesting implications because the rules require that this price be one which is in a market where there's an orderly transaction. During the GFC, 2008, 2009, there were arguments around when credit markets froze up, there were no markets. It certainly wasn't orderly. So could you even get a fair value? Even though things were sometimes from time to time exchanging, could it actually be a fair value? So that's, there are interesting implications from that. And there's certainly fair value has been criticized because the argument goes, it exacerbated some of the loss selling or the selling into the losing market because as banks, their assets that they were holding started to depreciate in value, they were then forced to dump those assets. And as they dumped those particular assets, it dumped them into a losing market, which meant the prices just kept spiraling down. And there were quite strong arguments that fair value accounting, which international regulators and US regulators had in place, actually exacerbated some of the problems. And finally, value in use. And what value in use represents is the benefit that you're going to receive from using this particular asset. So say you have a piece of land that you rent out. The value in use would be the present values of those future rental yields, and then ultimately what you think you can sell the asset for down the line. That is actually not that different, I suppose, if you think about share valuation, where they're using, they're valuing the dividend stream and then whatever capitalization was in there to come up with the value for those shares. So there are a bunch of different measurement systems, and different assets and different liabilities will use slightly different ones. So for receivables, what we show, and so this is delving into the notes for Woolworths, what we show is on the face, and I'll use a number down here, the 744.7 is the current receivables that they show. But this doesn't necessarily represent the gross value of those receivables, because it is likely that somebody that you have sold to is not going to be able to pay you back. And in that case, you actually reduce it by an amount that you expect to not collect. And that's commonly called an allowance for doubtful debts. In Woolworth's case, they call it a provision for impairment, but it means much the same thing. So the provision for impairment on the trade receivables is $14.8 million. So they expect to not collect just over 10%. I don't know if that's good or bad, but that's what they expect. Other receivables looks like it's slightly under 10%. But again, it helps provide you more information about what's going on. So Tom's Toys, as an example, sells toys to retail customers with invoices totaling $100,000. The full amount is unlikely to be collected, and so an adjustment is required. And so from a worksheet point of view, we would have the sale taking place, and they would have accounts receivable of 100 and sales revenue of 100. So asset gets affected, asset goes up, equity is affected. Ultimately, equity goes up. The adjustment, and you'll note I haven't put a number in there because we don't have enough information to put in a number. That allowance for doubtful debts is what's called a Contra account. It's an account which is linked to another one. And so the allowance for doubtful debts can't exist on its own in the wilderness. It has to have a buddy account. So it has to go with accounts receivable. The way you come up with this, there's a variety of different ways to determine it. And as long as it's done in a reasoned manner, obviously you can verify what the numbers are and the decision making around it, and the auditor is happy with it, then that's a number which gets used. An example could be percentage of sales. It could be aging of accounts. Again, a whole bunch of different ways to do it. But when you make that adjustment, you are effectively reducing the balance sheet, so the asset side of things. So you're not showing $100,000 in assets anymore. You're showing maybe $99,000. And you're not showing $100,000 in profit. If this was the only set of entries, you'd be showing $99,000 in profit. So again, it's just small adjustments, but we now have a level of subjectivity. Turning now to inventory, the carrying value of inventory must be the lower of its cost price or net realizable value. We'll look at what this means with an example shortly. Measuring inventory at cost also requires an assumption, because inventory is generally purchased not all in one hit over a period, and oftentimes inventory prices can change. And that could be for a variety of different reasons. It could be quantity discounts. It could be there are sort of issues with supply. It could be, again, other things that are going on in the market. The two cost assumptions permitted in Australia are first in, first out, so FIFO, and weighted average. We actually do have a separate video on this, so please check the link for that, which actually works through a fully worked out FIFO and weighted average, and how to sort of work out those costs and how to come up with the expense and the closing inventory figure. And once you've done all of them, we still have to check the cost against net realizable value. Because if what you're holding in inventory is worth less than what it is on the books, then you've got to take it down. So the net realizable value is the expected selling price, so what you expect to get for it, less any costs associated with getting it ready, costs which you haven't yet spent, so what you expect to spend, and then add on any costs of marketing, selling, and distribution. For ease of use, just for the moment, just take it as this is what you could sell it for. So what we've got it on the books versus what we can sell it for. So putting some numbers behind it, which is always beneficial. So Tom's Toys has 50,000 fidget spinners in stock, for which it paid $1.50 per unit. And the fidget spinner market has collapsed. I remember when these things were absolutely everywhere. And like all fads, they seem to have disappeared. The net realizable value is only $1.20 per unit now. So what this means is they would be buying these in for $1.50, expecting to sell them for more than that, $2.50, $3, whatever. For only $1.20, they're not even going to cover what it costs to buy them. So the purchase would be $75 down in cash and $75 up in inventory. This reflects the purchase of those fidget spinners and putting them into stock. The adjustment is an inventory decline of $15,000 and a loss on write-down, which is obviously going to be a negative thing, which then negatively impacts equity. The cost is the 50 times $1.50. The net realizable value is the 50 times $1.20, and the difference is $15,000. And you have to take the cost if it's lower, or in this case, net realizable value, which is the lower one. If net realizable value is higher, so if they could be getting $2 a unit, you don't adjust it upwards. So the $1.50 which they paid for it is the most that inventory could be on the books. It can be lower than that, but it can never be higher than that. Turning now to non-current assets, and the first bit of non-current assets relates to depreciation. And this is one of those things for accountants that you see it talked about, and it means in quote unquote the real world something slightly different than it does to accountants. In the real world, when we think about depreciation, we think about change in value. So, you drive a car off the lot and it loses 30% of its value in depreciation. That is not what accounting depreciation is. Accounting depreciation is the allocation of the depreciable amount over the life of the asset. Land is not depreciated. Land isn't depreciated because there is no life of the asset. It just exists. There are a number of commonly used methods to calculate depreciation, and these include straight line, reducing balance, units of production. We're going to look at two just to get a sense of kind of what can be used. In this case, Tom's Toys, they've decided to purchase a delivery truck on the 1st of July 2016 for $65,000. The estimated useful life is only 5 years. Obviously not a great truck, or only 100,000 kilometers. That's not that far. But anyway, I digress. The estimated residual value is $15,000. So what this means, at the start of the useful life, the truck had an objective number of $65,000. That is what it was worth. At the end of the 5 years, or the estimated useful life, it is expected to have a residual value of $15,000. This means this is what we expect it to have. This number is subjective. This is a management assertion about what they think it's going to be worth. We then have a 5-year window, or 5-year period, where we have to allocate that difference, so 65 minus 15, we've got to allocate that $50,000 into those 5 years. The method we choose will help identify how we do that. And again, there are a bunch of different ways in which we could go about doing that. One of which is the straight line method. And the straight line method simply takes the depreciable amount, which is cost minus residual, and divides it by the useful life, which in this case is $10,000 a year. So the purchase happens, $65,000 cash going out, $65,000 in truck coming in. So there's no net effect. The adjustment leads to an accumulated depreciation of $10,000. So that's a negative effect to the asset side. So accumulated depreciation is another Contra account and exists with the truck. So this means the carrying value of the truck overall is now only $55,000. The depreciation expense is recorded at $10,000. And then you would just repeat that for another 4 years. There is a fully worked up example all the way through for this in another video, which there'll be links available. The second one, just to show you how these things actually do differ a little bit, is units of production. And in units of production, we have the cost minus a residual. So we still have the depreciable amount. And instead of using useful life in years, we use useful life in kilometers. And then we multiply it by whatever the number of kilometers driven in that particular year is. So if they drive 24,000 kilometers in the first year, the depreciation for that year, the depreciable amount is 50,000 divided by the 100,000 kilometers gives you 50 cents per kilometer. So each kilometer this truck drives, they will attach 50 cents of depreciation against it. So if they do 24,000 kilometers, they'll have $12,000 of depreciation in that year. Now, again, these are all estimates and things don't always work out as planned. And there are ways in the rules which allow us to make adjustments for those changes in estimates. It's not something that we will cover in this particular subject, but as always, if you are interested, please get in touch and put a post up and I can certainly cover that off for you. Non-current assets also change in value. We're seeing that quite a lot at the moment. There are policy settings in place which allow for entities to account for those changes. And depending on the type of asset you're talking about, they have slightly different ways of dealing with this. This is not a focus of this subject. There's quite a lot of kind of detailed look into how we do this. For those that are progressing further on in their accounting journey, you will absolutely cover these sort of things. But for the rest of you, this is not something that we're going to delve into too deeply. But as always, if you are interested, I am more than happy to talk about it. Limitations of the statement of financial position. We're very close to the end now. Shows assets, liabilities, and equity values at a point in time. And that may not be representative of another point in time. There might be cyclical issues, there might be structural issues, there might be sort of major changes with what's happened. It's a snapshot. And like we know, we're looking at photos in general. Photos don't, if taken at the wrong point, of the wrong angle, or the rest of it, may show not quite the reality. So that's something to be aware of here. The entity's value is not reflected properly. And this may be because, and we would have touched on this early on, is that not every item that is a benefit or potentially involves a future sacrifice actually meets either the definition or the recognition criteria, or either. So things like brand names, for the most part, don't meet the criteria that's required to be recognized. And as such, brand names, generally speaking, you do not see them. There's a whole range of other things that come about that we don't see on there. And that means that the accounting value of a company is usually quite removed from the market value of a company. Now, that's not to say that these numbers don't have a level of benefit. They are useful, but it's not completely reflected. The use of historical costs in the statement of financial position, just generally, like why is something from 10 years ago relevant for decision makers now? Who knows? But that is an issue with using historical costs. And certainly when I was working at the IFRS, so the IASB, so the IFRS Foundation, there were some very strong proponents that everything should be fair valued. Now, I don't believe that should be the case, because there are some quite difficult operational things to deal with actually making that happen. But fair value, if it's a kind of current value, if it gives you some idea of what things are worth in the market now, that may be more useful for decision makers. Preparation requires use of management choice, professional judgments, and subjective estimations. As noted when we talked about accounting policies, there is a set of rules. So there is a set of permissible choices that management can make. But within that, there is still choice. And there's choice, and there's judgment, and there's estimations in there. And look, it always sounds really cynical when you hear people talk about, this leads to bad things, and it can, and it has. For the most part, most companies will do things as best they can. And from time to time, this leads to, there does end up in some bad, you do see some bad situations. But for the most part, companies are doing their level best within the time and the constraints they've got in front of them to do the best job that they can. So in terms of summary, we looked at the purpose of the statement, format and presentation. We talked about the measurement principle in general in relation to assets and liabilities. We looked at accounting for receivables, inventory and non-current assets, and we started to talk about some of the limitations of the statement in question. And that covers an introduction to the statement of financial position.